All right, let's dive right into this explainer. We're going to demystify the highly technical, frankly secretive mechanics that ultra-high net worth individuals use to absolutely multiply their capital. We're looking strictly at the data and the raw strategies to uncover exactly how family offices operate as the ultimate wealth generation engines.
So, to really understand these mechanics, we've got to ask a basic question. How are half-billion-dollar fortunes actually structured so they survive across generations? I mean, think about it. When you sell a company and walk away with hundreds of millions of dollars, a traditional private bank just isn't going to cut it anymore. You're suddenly dealing with maybe 30-plus legal entities across multiple countries, various asset classes, multi-generational inheritance plans, and a massive staff. Managing all of that through fragmented advisors gets chaotic fast.
And that brings us to the foundational blueprint of a family office, what we call the control tower. It starts with a CFO to consolidate the balance sheet, right? Then a trust lawyer is brought in to build legal firewalls and a tax specialist to map out the logistics and efficiencies. But the real magic, the true wealth generation, that happens at step 4 with the chief investment officer. This is the person with deep access to private deals and alternative markets. They're literally the engine for growth, turning preserved wealth into compounding generational empires. Here's our roadmap for today. We'll be covering the wealth generation engine, the private equity advantage, direct deals and co-investing, real assets and infrastructure, and finally, unconventional alternative assets. Let's get into it.
Part 1. The Wealth Generation Engine, targeting those sweet 11% returns.
It's pretty fascinating that there's a massive 42% allocation specifically to alternative assets here. Family offices generally target an average return of around 11%. And look, they're not getting there just by holding public stocks and bonds. They are heavily deploying capital into private equity, private debt, hedge funds, venture capital, the whole shebang. By operating this way, these family offices essentially function as their own highly agile private equity firms.
Moving on to Part 2, the private equity advantage and the incredible power of patient capital.
There is a really stark contrast between traditional PE and family offices. Traditional private equity firms raise money from external limited partners, which means they're forced to operate on fixed 5 to 7-year fund lives. There's this intense pressure to create value quickly and get out. Family offices, they deploy what we call patient capital. They have no external LPs, no fixed exit timelines, and absolutely zero quarterly performance pressure. They can just hold assets indefinitely through market cycles, giving their portfolio companies the actual time they need to realize their full operational value. It's a massive structural advantage. Part 3. Direct deals and co-investing. Here's how they bypass traditional PE funds altogether. To execute these direct deals, chief investment officers rely heavily on independent sponsors. If you aren't familiar with the term, these are highly experienced deal sourcers who don't actually manage a dedicated fund. Instead, they find a specific target, negotiate the deal, and then raise capital from family offices on a per-deal basis. The family office then uses an SPV, or a special purpose vehicle, to cleanly hold that single asset on their cap table. This perfectly isolates the risk. The absolutely crucial takeaway here is that by bypassing traditional private equity funds, family offices keep total control. They pick the exact sector, they dictate the holding period, and they choose the exit strategy. But honestly, the biggest win? They completely eliminate the standard 2% management fee and 20% performance fee drag that traditional funds charge. Bypassing that 2 and 20 model lets them tailor tax structures for a single asset and keep significantly more of that generated wealth right inside the family. Section 4. Real assets and infrastructure, driven by the 3Ds megatrends.
So the long-term opportunities for private capital right now are sitting in these 3 structural transformations, often called the 3Ds. We're talking about digitalization through AI, deglobalization as countries reshore their critical supply chains, and decarbonization of the energy grid. Make no mistake, these aren't just temporary fads. They are driving a massive global infrastructure investment supercycle that analysts expect will require over $100 trillion by 2040. That's a staggering amount of capital.
For instance, artificial intelligence is fundamentally changing infrastructure demands. We're shifting away from traditional data centers to what are effectively AI factories. Building these hyperscale facilities is intensely capital-heavy. You're looking at over $10 million per megawatt just to construct the building. And once you add the compute infrastructure inside, that pushes the cost to over $30 million per megawatt. Because of that, hyperscaler capital expenditure is soaring exponentially, and it's projected to hit $1 trillion by 2030. At the exact same time, AI workloads are demanding up to 10 times more power per rack than your conventional computing. Sovereigns and tech giants simply cannot fund this all by themselves, and that creates a perfect void for deep-pocketed, agile family offices to step right in, formulate innovative capital partnerships, and essentially fund the digital backbone of our economy. In return, they get steady, inflation-linked long-term yields. It's brilliant.
And finally, Part 5, Unconventional and Alternative Assets. Let's look at some highly specialized wealth plays. Now, because family offices aren't facing redemption pressures from outside clients getting spooked, they can maintain agile cash reserves to aggressively pursue distressed investing. When a company hits a distressing event, a massive arbitrage gap usually opens up between how lenders originally valued the firm and how the panicked market is currently pricing it. Family offices love to swoop in during these downturns and buy up distressed debt or assets. It's a classic wealth-multiplying strategy, literally the exact same playbook the Rockefellers used to buy up oil refineries during market panics.
And this sophistication extends even to unconventional passion assets like fine art and cultural heritage. They aren't just hanging expensive art on a wall. They treat it with intense institutional rigor. Just look at the tech adoption. 67% prioritized advanced collection management tools, and 54% are heavily utilizing risk management technologies. They're applying the exact same professional governance, data analytics, and wealth structuring to their art collections as they do to their private equity portfolios. It's all about ensuring that legacy is protected across generations. Ultimately, the wealth generation engine of a family office isn't just about having more money than everyone else. It's about having better mechanics. Their unmatched flexibility, their freedom from short-term public market pressures, and their infinite time frame, these are the ultimate weapons of wealth generation. They can confidently take on the illiquidity that terrifies other investors, and they'll happily reap the rewards over decades.
We've seen exactly how independent sponsors, direct private equity deals, and AI infrastructure form the billionaire's blueprint. So knowing how the elite structure their empires, how will you shift your own investment timeline away from quarterly pressures and toward true generational compounding? Think about it.